Investment Trends and Predictions for 2025. A comprehensive overview of the investment landscape for 2025 is poised to be shaped by several influential trends and predictions, as global economic recovery and technological advancements continue to unfold. One of the primary areas of focus is the growing importance of sustainable investing. As climate awareness reaches unprecedented levels, investors are increasingly directing funds towards companies that prioritize environmental, social, and governance (ESG) criteria. The future of investing in 2025 is likely to be shaped by a range of factors, including emerging trends and technologies, changing global economic dynamics, and shifting investor preferences. Sustainability is becoming increasingly important in real estate, with a growing focus on eco-friendly developments. Environmental, social and governance, ESG, investment risk. The lack of common or harmonized definitions and labels integrating ESG and sustainability criteria at EU level may result in different approaches by managers when setting ESG objectives. This trend is expected to gain further traction with mounting regulatory pressures and consumer demands for corporate responsibility. Additionally, technological innovations, particularly in artificial intelligence, AI, and blockchain, are set to revolutionize various sectors. AI-driven analytics will empower investors with predictive insights, enabling more strategic decision-making, while blockchain technologies will enhance transparency and security in financial transactions. The technology sector, particularly companies involved in artificial intelligence, AI, cloud computing, cybersecurity, and renewable energy, is expected to continue driving market growth in 2025. AI tools can analyze vast amounts of market data to predict trends and identify lucrative opportunities, while blockchain technology ensures transparency and security in transactions. The rise of digital finance is likely to continue as fintech platforms evolve, offering more accessible and personalized investment options. Cryptocurrencies, despite their volatility, may become more integrated into mainstream portfolios as institutional interest grows and regulatory clarity improves. Furthermore, demographic shifts, such as the increasing influence of younger, tech-savvy investors, will shape the investment strategies towards more digital and tech-oriented assets. Accelerated by turnkey wealth-as-a-service platforms, more consumers will access sophisticated investment tools through financial institutions and digital wallets. With evolving regulations, technological advancements, and shifting investor sentiments, experts are analyzing trends that could shape the future of digital currencies. Finally, geopolitical tensions and economic policies will still pose uncertainties, making diversification and risk management crucial components of investment strategies. Overall, 2025 is expected to be a dynamic year for investors who can navigate these trends while adapting to the rapid pace of change. With the potential for both opportunities and risks across different sectors, a diversified investment strategy will be crucial for navigating the uncertainty ahead. Here's what changes investors can expect in the new year, and how strategists suggest investors might adapt. The growth of artificial intelligence. Impacts on the technology sector. As we approach 2025, the growth of artificial intelligence continues to exert significant influence on the technology sector, reshaping traditional business models and introducing new opportunities. AI technologies are increasingly integrated into various applications, from consumer-facing products like virtual assistants to critical enterprise solutions, enhancing efficiency and innovation. This integration drives demand for advanced hardware, such as powerful processors and storage solutions, and necessitates robust software and machine learning algorithms. Throughout 2024, new artificial intelligence (AI) capabilities continued to develop at a rapid pace, highlighting the need for technology businesses to reshape, reposition and innovate in a world led by the promise of generative AI, Gen AI. Consumers are increasingly looking for AI-driven products and services, such as virtual assistants and chatbots, to streamline their daily tasks and improve their overall experience. The strategy includes building advanced hardware and software to meet the rising demand for AI applications across multiple industries. Consequently, the tech sector is experiencing a surge in investment focused on research and development to harness AI capabilities, leading to breakthroughs in automation and analytics. Moreover, AI's role in optimizing operations and personalizing user experiences has prompted a competitive edge among tech companies, fostering an environment of rapid innovation. As AI continues to mature, Concerns about data privacy and ethical deployment also press companies to adopt practices ensuring responsible and transparent AI use. Strategic investments. Additional cash flow allows for increased investment in research and development, potentially leading to new product innovations and market opportunities. The company has been aggressively integrating AI capabilities into its core offerings, aiming to enhance user experiences and maintain its competitive edge. Although this legislation does not carry much legal weight, it reflects the growing push to prioritize data privacy and compel AI companies to be more transparent and cautious about how they compile training data. Overall, AI's ascent is catalyzing growth within the tech sector, reflecting its potential to transform industries and drive economic expansion in the years to come. Artificial intelligence, AI, is beginning to drive substantial top-line growth for technology companies beyond the semiconductor sector, creating potential investment opportunities across an expanding AI ecosystem. Navigating inflation and interest rates. Strategies for bonds and real estate investments as investors look towards 2025. Navigating the complex landscape of inflation and interest rates remains crucial, especially for those involved in bonds and real estate. Inflationary pressures can erode the purchasing power of future cash flows, making it vital for bond investors to seek opportunities in inflation-protected securities. These instruments, such as Treasury inflation-protected securities, TIPS, adjust the principal value in line with inflation, thereby safeguarding the investment's real return. Investors may want to look at shifting toward lower duration bonds, which have less exposure to inflation and rising interest rates. These particular securities are indexed to inflation in order to protect investors from a decline in their purchasing power. Treasury inflation-protected securities, TIPS, are inflation-linked securities issued by the U.S. government whose principal value is adjusted periodically in accordance with the rise and fall in the inflation rate. Meanwhile, keeping a keen eye on the central bank's interest rate policies can help investors anticipate shifts that may influence bond prices and yields. In the real estate sector, inflation can be a double-edged sword. While it can increase property values, aligning investment strategy with rental markets benefiting from inflation-linked rent increases can provide a hedge against its detrimental effects. Furthermore, locking in low-interest, long-term financing remains a favored strategy to mitigate rising rate environments. Investors must keep an eye on inflation, economic recovery, and central bank policies, especially from the U.S. Federal Reserve, as these will provide critical clues about future interest rate decisions. Real estate investments. Property values and rental income generally rise with inflation, but higher interest rates can make borrowing more expensive, slowing down the real estate market. This should be supportive for keeping long-term interest rates lower in the near term. Strategic diversification, along with a focus on locations with robust economic prospects, can bolster real estate portfolios as they navigate the economic currents shaped by these pervasive financial forces. By adding real estate to their investment mix, investors can create a balanced and resilient portfolio capable of weathering market fluctuations and economic uncertainties. Stock market volatility versus stability. What investors can expect in 2025? As we approach 2025, investors are keenly assessing the balance between stock market volatility and stability. Following the turbulence of the early 2020s, marked by a global pandemic, geopolitical tensions, and significant shifts in monetary policy, many are hopeful for more stable economic conditions. However, the landscape remains unpredictable, with both opportunities and risks on the horizon. As we approach the end of 2024, analysts are busy assessing the factors that will influence the stock market in 2025. Markets remain vulnerable to sudden shifts in monetary policy expectations, especially if future economic conditions were to diverge across major economies. Opportunities, however, are emerging for investors with the risk appetite to take contrarian positions. Technological advancements continue to drive market dynamism, especially in sectors like renewable energy, artificial intelligence, and biotechnology. These innovations could lead to substantial market shifts, providing both volatility and potential growth opportunities. Meanwhile, ongoing global challenges, including climate change and political uncertainties, may contribute to market fluctuations. The ongoing advancements in artificial intelligence and other emerging technologies are likely to continue driving growth in the technology sector, a significant component of the S&P 500. This highlights the increased volatility in market sentiment, especially after years of strong growth and the potential risk of a market correction. Economic uncertainty, political events, natural disasters, and global economic situations can all create uncertainty in the market, which may influence mortgage rates. Central banks worldwide have been focusing on maintaining economic stability, with monetary policies aimed at controlling inflation and fostering growth. Their actions will play a critical role in influencing market trajectories. Ultimately, while investors in 2025 can anticipate periods of volatility, a strategic approach focused on diversification and resilience can help navigate potential instability, positioning them to capitalize on emerging market trends and opportunities. Therefore, policymakers and central banks often prioritize controlling inflation to maintain stable economic conditions and foster sustainable growth. The dynamics of the market also play a pivotal role. Ultimately, while the 2025 market path is likely to be complex, it is also full of potential for astute investors able to navigate the dynamic interplay of economic trends, earnings strength, policy transformations, and valuation constraints. Stock market forecasts for 2025. Opportunities and risks. As investors look towards 2025, the stock market presents a mix of opportunities and risks shaped by evolving economic conditions, technological advancements, and geopolitical dynamics. On the opportunities front, sectors like technology and green energy are poised for significant growth, driven by innovation and increasing demand for sustainable solutions. Companies focused on artificial intelligence, renewable energy, and electric vehicles are likely to attract considerable investment, offering potential for substantial returns. The ongoing shift towards a post-pandemic world, combined with the rise of emerging technologies and changing global economic dynamics, presents both opportunities and challenges for investors. Fortunately, technological advancements in climate solutions have made them increasingly cost-competitive, providing significant investment and commercial opportunity that will help drive green development. Sectors like renewable energy, electric vehicles, and sustainable agriculture are expected to receive significant attention. The ongoing digital transformation across various industries continues to create fertile ground for investment, as businesses adapt to new technological paradigms and consumer behaviors. The digital transformation and adoption of AI technologies by industries has given rise to new advancements to solve and optimize many core challenges in the IT industry. However, investors need to navigate a landscape fraught with risks. Rising interest rates could dampen market enthusiasm, as central banks adjust monetary policies to curb inflationary pressures. This environment could lead to increased volatility, particularly affecting high-growth tech stocks that are sensitive to interest rate changes. Geopolitical tensions, such as trade disputes or geopolitical conflicts, pose additional threats to global market stability, potentially disrupting supply chains and affecting investor sentiment. However, investors should remain aware of potential risks and challenges. Central banks have been using interest rates as a tool to manage this recovery, and 2025 may see more gradual rate hikes as inflationary pressures begin to stabilize. An increase in interest rates, particularly when unexpected, can cause volatility as investors may fear slower economic growth. Market volatility was further exacerbated by geopolitical tensions, including the Russia-Ukraine conflict, which disrupted global supply chains. Furthermore, the uncertainty surrounding regulatory changes, particularly in the tech sector, might impact stock valuations and scare off investors wary of increased scrutiny. Market participants must balance these risks with the promising prospects by adopting a diversified portfolio strategy, staying informed on global developments, and being adaptable to swiftly changing market conditions. The substantial fiscal adjustments anticipated in the coming years are worrying for the broader market, particularly as investors grapple with increased uncertainty surrounding federal policies. Investors are encouraged to adopt a balanced strategy, focusing on diversified portfolios to mitigate risks while capitalizing on growth opportunities.